Hello, good morning, trade pros. Welcome to our morning market update for Friday, February the 9th of 2018. Today, I want to talk to you about a lot of things. We're gonna review a ton of stuff, and I'm gonna tell you where I think the market's going. We're seeing a continuation to the downside in this trend, and I'll talk to you where we could be headed next. I'm gonna bring up my notes here. Trade pros in the room, you're gonna see what I'm talking about ahead of time. That's one of the major advantages the subscription. Today we're going to talk about why the S&P 500 continues to sell off. We're also going to talk about today about some earnings that came out last night. We're also going to talk about a government shutdown that was avoided, and we are going to talk about U.S. stock funds. They experienced a record outflow, and last but not least, Mark Zuckerberg, something he said, and my personal opinion on it, and what you could think for yourself. All right, let's start out by saying this. Yesterday we had some earnings come out. The big ones are Nvidia. Nvidia came out with some bigger chip demand in their department. The GPUs is what they call it. That is up 7.5% pre-market. We also got AIG. It was pretty much flat, with hurt by tax reform measures and wildfires as well. I can't talk today. Philip Morris is up 1.6%, and Twitter is up 12.1% after finally turning a profit. It took everybody to forget about Twitter for it to start making money. Interesting stuff. Markets continue to the downside, and they're selling off sharp. In Asia, Japan's down 2.3%. Hong Kong's down 3.1%. China down 4%, and India down 1.2%. So this bearishness is continuing. In the industry, there's something called a dead cat bounce. What does it mean? When the market drops steeply, and it gets too fast, too far, and a little bit of ahead of itself on the correction side, the stocks bounce up. This bounce is statistically and traditionally what gets a lot of retail money stuck once again. Think about the dynamics. You go up, you get a ton of longs, you drop, and you shake out those longs. What is the one thing I could tell you that all traders and investors know, regardless of how long they've been trading or investing for, is to buy the proverbial dip. Buy the dip. So they continue to buy the dip. So some of the retail traders that are more amateur buy the dip. I don't blame you if that's you in that scenario, because you've been conditioned and trained to continue to buy the dip. But it's not always been like that. The markets are double-sided, and anyone who's just buying dips has been really lucky the last couple of years because it's worked. And frankly, you buy the dip, you get long, the retail money gets long, and then slams lower, runs the sell stops again, and now really the longs who haven't had as much experience and who've been kind of getting by with just buying dips have grapefruit eyes. They're sitting there in front of the screen like, what's going on? Well, I'll just get ready to buy the next dip. And suddenly the momentum has shifted from buying dips to selling rallies. And I said this before, when we switch to the downside market, you're going to get to see something you've never seen before. You're going to see a situation where there's a record number of short sellers in the volatility index, the VIX. They're getting squeezed out. A couple of the electronic traded notes, the products that track the VIX, the 2 times, 3 times leverage, have gone out of business, and volatility has only jumped to 50. I've seen volatility 90 plus, and I've told you there's a lot of traders short volatility. We're going to squeeze them out to every last penny and make a whole lot of greedy people go bankrupt. That's what's in the making right now in this market. And you have to remember that the market moves to the level that causes the greatest amount of pain and discomfort to the greatest amount of traders and participants. That's the truth. If you want to know where it's going, answer that question. That's where it's going. We're going to continue on this downside. Today, we're going to try to puncture that low. And if we push through the low, we could sell a lot. We could get a magnitude of 30, 40, even 50-point sell-off on the S&P 500. If we fail the low, then we may have a little bit of another dead cat bounce, and then it starts to transition a little bit. So sellers have the torch. They have the momentum. Do not go against momentum. You've had 5, 6 years since 2009, almost 10 years of bullish momentum. You could have bought the dips. You would have done great. I'm telling you, it's feeling different. I've switched to selling the rips, and I start with the idea of let me sell rips, and then I continue on with that idea until I'm wrong. And when I'm wrong, I have no issue switching to the buy side, because that's what it takes to be a trader. You don't need to have bias. You need to be profitable. Somebody yesterday asked on YouTube, well, if you need to be profitable, then why do you start out with a trade idea in the morning? Because if you don't have any sort of idea of where the momentum is going, what you have to do is watch the first 15 to 20 minutes. You don't have to have an idea, but you need to kind of get in with the momentum and watch for it, and you could be fooled I like to start with somewhat of a conceptualization, where will they go, and then be proven wrong, and then take the trade idea. A bias is something that you have, and it's firm, and it matches with your beliefs. An idea is a little different. Does that make sense for the person that asked? A bias means that you think you're going to defend that bias and fight for it, and you believe it up top in your head. It matches your values, and you're just going for it. That's how you go broke in the markets. A trading idea in the morning is different, because you just have something that you're looking for. If it's wrong, you go the other way. All right, it just makes it a little bit easier to be patient in the morning. It makes it easier to jump into your first trade. That first trade is pretty important for a lot of people in terms of how emotions play out in the day. So put all your time and effort to make sure the first trade of the day is a profitable one. All right. In London, down 0.6%. Paris is down 1.2%. Frankfurt down 1.3%. So the carnage continues from Asia to Europe. In the United States, we're at Dow Jones up 0.6%. Excuse me, S&P up 0.8%. NASDAQ up 0.9%. So you're getting a little bit of a rebound in equities here in the U.S. session. I don't think that'll last. I think that's a dead cat bounce part 2. All right. Why is it called dead cat bounce? Because if a cat fell off a 50-story building and hit the ground, it would bounce at least a little bit, but it's dead. It's graphic. That's the kind of people traders are. All right, crude oil is down another 1.1%, almost at 60. Crude oil is down almost 5 handles. That's huge. It's getting to the point of 10% levels, and the S&P did officially, by the way, hit correction territory. All right, gold prices are 0.2%. It's about 13.17, and Bitcoin, after a rebound off the 6,000 up to 82.68. I think Bitcoin is also a dead cat bounce. I think there's a little bit more pain to be felt in Bitcoin before it tries to make a rebound. Here's the one question that nobody can answer. I don't care how much you know about crypto and what your experience is with it. Nobody knows where cryptocurrencies are going in a market sell-off or a market crash scenario. The one question a lot of people have is, how will cryptocurrencies fare through a real recession? Will they take on the identity of an asset that goes up while the markets are going down along with the economy? Or will it correlate with risk assets and go down with them? If traders start putting money in crypto and continue to put money in crypto as markets are going down, that's a sign of resiliency. That's a sign of acceptance in the investing world as an asset that's inversely correlated, or what we call a fear asset. It goes up on fear. All right. Today's earnings, well, not earnings, today's news. Let me just look in a little bit, because I made it literally the smallest window possible. I made it like I didn't want to read it. Out of the UK, we had manufacturing production data, came out at 0.3 versus 0.3 expected. We also had some construction spending and industrial production numbers. No big news out of the United States today on the economic calendar, so continue to trade technicals in your charts. Out of Canada, we got some employment change statistics. We had minus 88,000 jobs versus 10.3 thousand expected. All right, and the unemployment rate upticked to 5.9% from 5.8. So the picture's not that rosy in Canada. Look for the Canadian dollar to weaken or to continue to weaken, and look to buy strong currencies against it if you're a currency trader today. One trade I'd be eyeing is long US, short CAD. All right. Yesterday, we had a shutdown in government. I don't know if you guys know. It lasted a few hours, and then that government shutdown reset. There's a new bill that was extended to March 23rd. So what the government's done is once again push that date forward. They can't come together and sit down and negotiate on behalf of the people and come up with a great agreement that would serve the people and that would create a responsible budget to move forward. So the government shut down last night, and it reopened 3 hours later after they came to a tentative agreement. They're basically pushing the date out again. So March 23rd, we go through all this government shutdown nonsense one more time. I think as a politician, you are elected into office to serve the people. By playing politics with another party and not coming to an agreement, you are not serving the people. Just go, pack your stuff and leave the office. If you're not going to work, why be there? That's it's a little bit firm and a little bit of a tough sentiment, but honestly, like, let's get real here. At some point, something's got to get announced. They've been kicking this thing down the road a lot. It's getting ridiculous at this point. March 23rd, it's getting more ridiculous because that's the new cutoff. Here's a really interesting statistic. On the downside, and I've kind of been pondering this a lot, the next time that a market crashes, which could be happening in this moment, here's a question we're going to ask. The field of investing has become extremely sophisticated. I remember when I started this business in 2012, there were very few providers of education who truly actually wanted to help investors succeed. A lot of them had products, but the not sure the motivation behind success was actually the real reason for the products. Now, I can tell you this, from day one, I left my job in finance and on the trading desk to be able to help people because I seen what it did to them in 2009. I think this time through, it's really interesting to see outflows of money. What does that mean? It means investors are becoming more active. With the emergence of ETF, electronic traded funds, which allow you to buy one ETF that will invest in a certain market type. For example, a growth ETF or a diversified overall basket index, which means you're not buying a specific stock, you're buying the whole market. Since that's become available to investors, I think they're making quicker moves. They're being more analytical and more educated to manage their money, which is great because nobody cares about their money more than you do. And you know that. No fund manager knows more than you. All right. Nobody knows how to manage your money better than you do. And it's interesting to see these statistics. U.S. stock funds saw $24 billion withdrawal last week. That excludes this week so far. That means $24 billion of market products were sold last week. So that, first of all, number one, that intensifies the pressure of this downside. It intensifies the sell-off and tells us there's more to come. Second of all, it's good to see smart investors making smart moves. I think that a lot of those $23.9 billion traders are on my YouTube channel. I'm not going to take credit for that. I'm just kidding. It'd be nice. I would be touched if that was the case, but it's not. That's the largest withdrawal on record ever. All right. ETFs or exchange traded funds accounted for the most of those withdrawals. $21 billion of ETFs were sold last week and money was redeemed. Okay. So mutual funds account for just $3 billion of the withdrawals. Let's take a quick look at these two products. And I know I'm going a little bit over time. TRADEPRO subscribers, I'll be in the room. I'm in the room now, but we'll open it up and talk about levels in just 1 minute. I want to finish on this point. Mutual funds, how are they sold? They're sold through banks, through institutions. They're sold by financial advisors who are actually salespeople in the cloak of somebody who knows a little bit about markets. They're trained behind the scenes. Don't get this confused. I know this. I've worked with thousands of them. They're trained behind the scenes to sell you something. Their pay is directly proportional to what they sell you. Obviously, they want to sell it to you. Very interesting to see mutual fund sell-offs only be $3 billion. Why is that? Because I bet you the client calls their advisor and says, I want to get out of my mutual funds. And the advisor says, listen, if you stay the course, then you're going to prosper in the long run. And then I want you guys to ask those advisors, how much do you have invested? Chances are they got a lot less invested than you, and they have a lot bigger of an opinion than you. That to me is a no-go. You can't mess around with stuff like that. I'm very happy to see, I'm touched to see that people are more active getting out of their ETFs. Mutual fund holders are staying a little bit the longer course because they're being persuaded to do that. Just be cautious with that strategy. If that's your strategy, know that it's your strategy and be okay with somebody else managing your money. And then at that point, when you make that decision, you're letting go of the fact that you care about the market because it's not your decision anymore. It's your money, but it's not your decisions. So if you decide to just stay the course and stay with the mutual funds, be sure to honor the decision and actually stay with them. Chances are it probably will rebound, but it's going to take you through the ringer first. All right. I wanted to say that. That's a very interesting statistic. $23.9 billion withdrawn. 21 of it was ETFs. $3 billion was mutual funds. That math doesn't really work out. Oh, yeah, it does. 24. Let me tell you guys this one last thing. Mark Zuckerberg is on a mission to prioritize, and I quote, meaningful social interactions. I'm using these air quotes a lot today. So Facebook is going to announce a feature that says downvote. I absolutely dislike that idea. If I could go on Mark Zuckerberg's page and he announced that on his page, I would dislike that. That's the only time I would use that button. Let me tell you why. In this universe, it takes a lot of energy to do anything. The energy to do something positive is a lot warmer feeling. To do something positive, to put out positive energy means you're going to get it back positive. All right, it's a universal law. Whatever you put out, you'll get. Clicking the dislike button, I'll tell you one thing. If you're going to really see something that you dislike and you have one click, what are you going to do? Click the dislike button or close the window and go do something else? Honestly, that is the dislike button. The dislike button is go somewhere else. And I'm going to start a petition to remove this dislike button. It's creating a lot of negativity in society. I see it happen to my YouTube channel, and I love it. I actually laugh when I see a dislike because I just laugh. I'm like, what are you disliking? clearly you dislike and don't value your time because you could just be doing something different. That's a dislike button. Anywho, I just wanted to share that because I have thoughts around it and opinions, and I have nobody else to talk to but you. So thank you for listening to me. I find that interesting. I think that spreads negativity. I'm not for it. I dislike that. I know what they're trying to do at Facebook, but it seems like they want to use it to see what content is disliked so they could remove it and downvote it. I think you just focus on the content that's being liked and show more of that. That's my opinion. Over and out. Trade the short side today. Sell rallies. Careful buying dips. Right now, momentum's to the downside. And if you're going to get in front of the freight train, you better have been working out and have an attempt to stop it. I advise you just get out of the way and go with momentum. You're going to get paid easier, quicker, with a lot less stress as a bear today. Good luck. Take care. Trade pros, let's open up the room and let's get in there and have another great day. So last day of the week, I'm feeling optimistic, energetic, and I'm running on the lowest amount of hours of sleep in weeks as well. So let's see how long this energy lasts. Take care, YouTube. Thank you so much for tuning in. I hope you enjoyed this. If you did enjoy it, please click the up like button. If you didn't, top right of the window, there's an X. But I'll see you tomorrow. Come back because maybe you'll like that. Tomorrow we have a YouTube video coming out, and Sunday as well. They're going to be more informational. Some exciting stuff I got planned. And then Monday we're back to morning market updates. Thank you so much. It's been a turbulent week. Have a great weekend to you and your families. No matter what you did this week, take this time to enjoy, relax, and unwind because we're going to be back here Monday morning, and we're going to kill it together as a group. All right, that's my pledge to you as a Trade Pro family. Take care, guys. Goodbye. I'll see you on Monday. Have a great weekend. Ciao. All right, Trade Pros, let's get in the room, talk about some